Everyone talks about Bitcoin's price, but almost nobody talks about what's actually backing the market behind the scenes. Because here's the uncomfortable question. What if a huge portion of Bitcoin trading isn't backed by real Bitcoin at all? What if the market is being driven by claims, promises, IOUs, instead of actual BTC moving on-chain? That's where the idea of paper Bitcoin comes in. And depending on who you ask, paper Bitcoin is either the reason Bitcoin went mainstream, or the biggest hidden risk in the entire crypto industry. Today we're breaking it all down. What paper Bitcoin actually is, why some believe there's more paper BTC than real BTC, how ETFs, exchanges, and institutions change the game, and whether this system could eventually threaten Bitcoin itself. Welcome to Web3 Verse. When most people think about Bitcoin, they imagine coins sitting safely in a wallet. Private keys. Self-custody, on-chain ownership. But in reality, a massive amount of Bitcoin exposure today works very differently. Most investors never touch actual BTC. Instead, they buy products tied to Bitcoin's price. Things like Bitcoin ETFs, futures contracts, exchange balances, treasury company shares, wrapped Bitcoin on other chains. That's what people call paper Bitcoin. It's exposure to Bitcoin without directly holding Bitcoin itself. And this isn't unique to crypto. The gold market works the same way. Most gold traders don't buy physical gold bars. They buy paper contracts that track gold's value. Bitcoin is slowly evolving into the exact same system. And for some people, that's terrifying. Now technically, paper Bitcoin has existed for years. Even early exchanges created forms of it. Back in Bitcoin's early days, users trusted exchanges to hold coins on their behalf. But many of those exchanges weren't properly backed. And history proved that in brutal fashion. Mt. Gox collapsed after losing massive amounts of BTC. FTX imploded after customer funds were misused. Bitfinex suffered huge hacks. And suddenly users realized something critical. The balance shown on your screen doesn't always mean the Bitcoin is really there. You may just be holding an IOU, claim, a promise, paper Bitcoin. And that realization permanently changed how people viewed custody in crypto. Then came 2017, the year everything changed. Because that was when the CME launched Bitcoin futures. For the first time ever, large institutional investors could gain Bitcoin exposure through regulated financial markets. And interestingly, the launch happened almost perfectly at the peak of the 2017 bull market. Now maybe that was coincidence. Or maybe introducing paper exposure changed the structure of the market overnight. Because futures allowed traders to speculate on Bitcoin without buying actual BTC. That meant massive capital could suddenly enter the market, without directly affecting on-chain supply. And from that point forward, Bitcoin stopped being just a decentralized asset. It became a financial product. Fast forward to today, and paper Bitcoin has exploded, especially through spot Bitcoin ETFs. Now on the surface, ETFs seem simple. You buy shares through a brokerage account, the ETF issuer buys Bitcoin, and the shares track BTC's price. Easy. But critics argue the system isn't fully transparent, because most ETF issuers don't publicly disclose all wallet addresses. That means investors are trusting custodians and institutions behind the scenes. And in crypto, trust is always controversial, especially after everything that happened with exchanges. Now to be fair, there's no evidence major ETF issuers are lying about reserves. In fact, on-chain analysts have tracked large wallets connected to some of these funds. But the broader concern remains. The more Bitcoin gets absorbed into traditional finance, the further it moves away from Bitcoin's original philosophy. Self-custody gets replaced by custodians. Decentralization gets replaced by institutions. And ownership becomes abstract. Then there's another major form of paper Bitcoin, treasury companies. And no company represents this trend more than Strategy, formerly MicroStrategy. They didn't just buy Bitcoin. They built their entire corporate identity around it. Over the years, they accumulated hundreds of thousands of BTC, more than many countries hold. And every time they bought more, the market reacted. But recently, critics started asking difficult questions. Why haven't some of these massive purchases moved the market more aggressively? Why hasn't there been stronger supply shock? And where exactly is all this Bitcoin being stored? Strategy says the Bitcoin is real. Michael Saylor has repeatedly defended the company's holdings. But because full wallet transparency hasn't been publicly provided, speculation continues. Some critics even claim portions of institutional Bitcoin may be rehypothecated, meaning the same BTC could theoretically support multiple financial claims at once. Now again, There's no confirmed evidence this is happening on a massive scale, but the fear itself matters. Because Bitcoin was created to eliminate uncertainty around ownership, and paper systems reintroduced that uncertainty. Now here's where things get really interesting. Paper Bitcoin doesn't just change ownership, it changes market behavior. Because once financial products dominate the ecosystem, price action becomes increasingly disconnected from real supply and demand. Take derivatives for example. Huge amounts of Bitcoin exposure are traded daily through futures and leverage products, but no actual BTC changes hands, just contracts. That means billions in Bitcoin activity can happen without affecting on-chain movement at all. And this creates a strange dynamic. The market starts reacting more to liquidity flows than to actual Bitcoin usage. In other words, the financial layer becomes bigger than the asset itself. And some believe that's exactly what happened to gold decades ago. Now, despite all the focus on ETFs, crypto exchanges remain the largest source of paper Bitcoin. Because when your BTC sits on an exchange, you don't truly control it. The exchange does. And unless you withdraw those coins into self-custody, you're trusting that the BTC actually exists and remains accessible. Most major exchanges now publish proof of reserves, which is definitely a step forward. But proof of reserves isn't perfect either, because reserves can change quickly, wallets can move, and liabilities are harder to verify than assets. That's why the phrase "not your keys, not your coins" still matters today, because history has already shown what happens when trust breaks. Then there's wrapped Bitcoin. This is where BTC gets tokenized onto other blockchains. For example, WBTC on Ethereum. You lock up real BTC with a custodian and receive a tokenized version that can be used inside DeFi. Now this unlocks a lot of utility: borrowing, lending, yield farming, liquidity provision. But it also introduces counterparty risk, because at the end of the day, you're trusting someone to actually hold the BTC backing those tokens. The difference is that wrapped Bitcoin systems are often more transparent. Many provide visible reserves on-chain, which ironically makes parts of DeFi more transparent than traditional finance itself. This is probably the biggest debate of all. Some Bitcoin supporters believe paper BTC suppresses price growth. The argument goes like this: if too much synthetic exposure exists, then institutions can create Bitcoin exposure without needing to buy actual Bitcoin. And if that's true, then supply scarcity becomes diluted. Critics often compare this to precious metals markets, where some believe paper gold trading keeps prices artificially controlled. Now, whether that's fully true for Bitcoin is still heavily debated. But one thing is undeniable: paper Bitcoin massively increases liquidity, and that liquidity changes how the market behaves. At the same time, paper Bitcoin is also one of the biggest reasons Bitcoin survived and matured. Because without institutional products, a lot of large capital would never enter crypto. Most pension funds can't self-custody BTC. Most traditional investors won't manage seed phrases. ETFs solved that problem. And that's why institutional adoption accelerated so quickly. So there's a trade-off. Paper Bitcoin increases accessibility, but reduces purity. It brings legitimacy, but also centralization. And crypto is still trying to figure out whether that compromise is worth it. Now let's talk worst-case scenario. Imagine a major custodian fails, or an institution loses access to reserves, or a massive exchange turns out to be under-collateralized. What happens? Confidence collapses instantly, because the system depends heavily on trust. And once trust disappears, everyone rushes for the exit at the same time. That's what happened with FTX. That's what happened with Mt. Gox. And many fear it could happen again at an even larger scale, especially now that institutional exposure is so massive. What makes this story fascinating is that Bitcoin was originally created to remove middlemen, to eliminate trust-based finance, to give individuals full control over their money. But ironically, as Bitcoin became mainstream, the ecosystem slowly rebuilt many of the same financial structures it was designed to escape: custodians, synthetic exposure, financial derivatives, institutional intermediaries. In many ways, traditional finance didn't adapt to Bitcoin. Bitcoin adapted to traditional finance. And whether that's bullish or dangerous depends entirely on who you ask. So, is paper Bitcoin a threat? Or is it simply the next phase of Bitcoin's evolution? The truth is probably somewhere in the middle, because without paper Bitcoin, Bitcoin may never have reached institutions. But if paper exposure grows too large, the market risks becoming disconnected from the asset itself. and that could create vulnerabilities most investors aren't prepared for. At the end of the day, Bitcoin's core promise remains the same: verify, don't trust. Which means the real question isn't whether paper Bitcoin exists. It's whether the system backing it can survive when markets come under pressure. So now I want to hear from you. Do you think paper Bitcoin is helping crypto grow, or quietly turning Bitcoin into another Wall Street product? Drop your thoughts in the comments below. And if you want to understand what could happen if institutional Bitcoin leverage starts breaking apart, check out the next video. This is Web3 Verse, and I'll see you in the next one.